9 states have zero income tax, and some can potentially drain your retirement. If you're thinking about relocating, you've probably already Googled the best states for retirees. But most retirement state rankings score lifestyle, healthcare, maybe income tax, but they leave out all the other costs. And even worse, they don't show how any of it applies to your situation. Because the popular states can look great on one metric and quietly punish you on 3 others. As a financial planner, I'm going to run 3 wealth level scenarios, 650,000, 1.5, and 2.9 million, through our 5 best and 5 worst states. Depending on where you are financially, one of these 3 is probably pretty close to you. You'll finally see exactly where your money may be safe and where it may not be, so you don't end up in a state wishing you'd never moved. So before we get into the states, what are the different ways a state can threaten your life savings in retirement? They take it through 4 doors. Every state opens at least one. The trick is knowing which before you move. Door 1, your retirement paycheck, the IRA, the 401k, and the pension. And you don't need a no income tax state to shut it. You'll see why later in the top 5. Door 2, your Social Security. Door 3, your estate. The taxes a state can take when you die are straight from your kids when they inherit. Door 4 is your address. Everything it costs just to live there. Property tax, sales tax, insurance, and even HOA dues. So that's the framework we're going to be challenging these states against. But depending on your wealth level, the rules can change entirely. So we'll look at 3 fictitious families. Linda, single, 68, about 650,000 all in, living on a 50 grand pension plus Social Security. The Millers, married, 66, about 1.5 million, 95 a year from IRAs and Social Security. The Whitmans, 70, about 2.9 million, 150 grand a year. And if you're in your 50s or early 60s and haven't pulled the trigger yet, these families can help give you an idea of how your own next decade could play out while there's still time to steer it. So let's get into the states. We'll start by counting down the 5 worst, starting with our number 5, which is going to tax these families almost nothing and still cost them more per year than nearly any state in this video. It's New Jersey. Surprisingly, New Jersey barely touches these families' income. Social Security is exempt, and if your income is $100,000 or less, a married couple can exclude up to $100,000 of pension and IRA income. For a single filer, it's $75,000. So Linda pays 0 state income tax. The Millers, pulling $95,000, also avoid it. At first, New Jersey looks like a gift, but there are 2 catches. First, the cliff. As your New Jersey income rises, the state cuts back the retirement income exclusion. And here's the wrinkle. Social Security doesn't count toward that line, but IRA withdrawals do. Once you pass $100,000, the benefit starts shrinking. Then at $150,001, $1 over, the remaining exclusion disappears. That's where the Whitmans are exposed. Their $105,000 of withdrawals has already cost them half the break. And with RMDs coming on a $1.6 million IRA, that $150,001 line is exactly where they're headed. The second catch, and the real bill, is door 4, your address. New Jersey has the highest effective property taxes in America, averaging around 2.2%. And this is where all 3 families feel it. Linda, about $7,000 a year, the Millers, about $12,000, and the Whitmans, around $20,000. Property tax doesn't care how your money is doing. The market can crash, your dividends can get cut in half, and the bill still arrives every year. New Jersey doesn't need to tax your income. It taxes your address. At our number 4, Massachusetts. Like New Jersey, Massachusetts opens one of the 4 doors, but this time it's door 3, your estate. It's what happens to your money when you're gone. Massachusetts has an estate tax, one of only about a dozen states that still does. And the trigger is at the $2 million line. Stay under it, and the state doesn't touch your estate. Cross it, and a tax bill appears. Linda is nowhere near this line. Neither are the Millers. Their estates stay below Massachusetts' threshold. But the Whitmans are where Massachusetts opens the door. They're not billionaires. They're a couple who worked hard and saved for decades building a $2.9 million retirement. That puts them $900,000 above Massachusetts' exemption, creating an estate tax bill of roughly $73,000. And that's the trap. Most retirees don't think of themselves as estate tax people. They assume only the ultra-wealthy need to worry about estate planning. But in Massachusetts, a paid off home, retirement accounts, and decades of saving can quietly push you into that category. And there's another issue every married couple needs to understand. That $2 million exemption isn't portable between spouses, meaning if one spouse dies and everything passes to the survivor, which is what most couples naturally do, the unused exemption doesn't transfer. The surviving spouse can be left with one exemption instead of two. Fail to plan around that, and families can lose tens of thousands of dollars. The verdict? Massachusetts is invisible to Linda and the Millers. But for the Whitmans, it can turn a successful retirement into what can be a $70,000 plus estate tax problem. Next up at our number 3, it's Vermont. So far, the damage has flowed uphill. Vermont flips that, the one state on this list that punches down. Vermont opens door 2. Social Security, and it's one of only 8 states that still taxes it. The others you can see on the screen now. Have a look if yours is on there. Vermont's thresholds are the lowest in America. The full break ends at $55,000 of income for a single filer and $70,000 for couples, disappearing completely about $10,000 above that, which makes this Linda's section. You don't need a huge retirement account to get caught. Her pension plus Social Security puts her around $70,000 of income, past Vermont's single filer threshold. Her bill, approximately $2,500. But Vermont gets worse because door 4 opens too, taxing your address. Vermont's property taxes are among the highest in the country. Linda's modest home adds approximately $5,000 a year, and for the Whitmans' $900,000 house, around $14,000. The verdict? Vermont can cost Linda about $7,500 a year, and she's the smallest saver in this video. Second on this list, one of my favorite states, Minnesota. Some rankings put it near the top for retirement. The healthcare, in my opinion, is genuinely excellent, but a great place to live and a great place to keep your money are two very different questions. And Minnesota is a perfect example because it opens 3 doors at once. Door 1, it taxes most retirement income on one of the steepest ladders in the country, up to 9.85% with no broad pension exclusion. Door 2, taxing Social Security. The Millers are defended keeping their bill under $1,500. The Whitmans at $150,000 lose that defense and their bill rises to roughly $6,000 to $7,000. On top of that, there's door 3. Minnesota taxes your estate, and the trigger is $3 million per person. The Whitmans sit at $2.9 million, just $100,000 below the line. But unlike some states, this isn't a cliff, it's a meter. Cross the threshold, and Minnesota taxes the amount above it. A move from $2.9 million to $3.5 million, one good market year, one inheritance, one home appreciation could create an estate tax bill of roughly $65,000. And that's the thing about Minnesota. It doesn't punish people who failed to plan, it catches the people who did everything right. I watched that happen to people I grew up around. Hardworking savers who did everything they were supposed to and still got hit hard because they didn't know what they didn't know. That's exactly why I do what I do today. At this point, I'm guessing you already know which state is number 1. Well, you're wrong. It's not California, and I'll tell you exactly why in a minute. Our number 1 worst state for retirement taxes is Oregon, because it's the only state on this list that opens door number 1 and door 3 for almost every family. Door 1, because while you're alive, Social Security is exempt, credit where it's due, but pensions and retirement withdrawals are taxed at rates up to 9.9%. Linda can pay about $3,000 a year on her pension. The Whitmans can pay around $7,000. Those are some of the biggest annual retirement tax bills on this list. Then there's door number 3, your estate. Oregon has the lowest estate tax exemption in America, $1 million. It's not indexed for inflation, and it's not portable between spouses. So Linda escapes barely, but the Millers, a couple with a normal house and one solid IRA who never considered themselves wealthy, can leave behind an estate tax bill of about $50,000. The Whitmans, nearly $200,000. In contrast, neither family would owe a dollar of federal estate tax. Oregon is the only state on this list that consistently hits our families both while they're alive and after they're gone. And if a number like that just made your stomach drop, $50,000, $200,000, taken from what someone spent a lifetime building, as a financial planner, these are exactly the kind of high tax decisions I help people navigate in retirement. There's a link in the description to book a call with me, and I'll take a look at your situation. So that's our 5 worst states for retirement taxes. Next, I'm going to cover our 5 best. But first, let's address the elephant in the room, as I know some of you have been yelling at your screen for 5 minutes, "Where's California?" Because if you only look at the headlines, California should be the worst state in America for retirees. High taxes, expensive housing, and millions of people leaving every year. But when you actually run California through the 4 doors and apply it to our 3 families, something surprising happens. It doesn't crack the bottom 5. Door 2 is closed. California doesn't tax Social Security. Door 3 is closed. California has no estate tax. And door 4 is more complicated than people think. Thanks to Proposition 13, long-term homeowners can have property tax bills far lower than the headlines suggest because assessed values are limited to about 2% annual growth. Now take the family who should get hit the hardest, the Whitmans. Their $105,000 of retirement withdrawals after deductions creates roughly a $2,800 California income tax bill. The Millers are under $1,000 and Linda is around $1,200. Those are some of the smallest income tax bills in this entire ranking. So why does everyone flee? Because California's biggest problems are not always the retirement taxes people talk about. They're the slow fuses. Future RMDs can push the Whitmans into higher brackets. Capital gains are taxed as ordinary income, and selling a long-held California home can create a tax bill above the federal exclusion. Then there's the cost of living, housing, insurance, and everything else that comes with living there. But remember, this is a tax list. For someone earning several $100,000 a year or selling a business, California is a completely different conversation. At that level, it can become one of the most expensive states in the country. But for the retirees in our scenarios, California's tax code barely notices you. And that's the point of the entire framework. The state everyone assumes is the villain often isn't the one taking the biggest bite. It's the high costs behind the doors nobody talks about. And real quick, if you found this video useful, feel free to subscribe. I put out new videos like this every week, helping to guide you on all things retirement so you can have the clarity you need when you decide to pull the trigger. Let's get into our 5 best. And this is where the usual advice starts breaking down because 2 states on this list have an income tax and 1 retirement-friendly state comes with a surprising estate trap. Our number 5, Tennessee. 0 income tax, 0 estate tax, 0 inheritance tax. Property tax is around 0.5%, among the gentlest in the country. The catch? One of 2 highest combined sales taxes in America, roughly 9.6%. And it's one of the few states that still taxes groceries. Invisible income tax on your lifestyle. But keep proportion. A sales tax hits what you spend. Income and estate taxes hit what you've built. The tax on what you built is always the bigger number. Our number 4, Nevada. Nothing to file. No income tax, no estate tax, no inheritance tax, and property taxes among the lowest in the country, which is exactly what separates it from Texas. The catch isn't a tax, it's healthcare. Nevada sits near the bottom nationally for physicians per capita. Las Vegas and Reno work, but rural Nevada needs a plan. Now, remember, I said 2 of the best states still have an income tax. Here's the first one, and I'd bet money it's not the state you guessed. At our number 3, it's Iowa. This is the one nobody sees coming. But Iowa rebuilt its tax code, and for retirees, it now does something most people wouldn't expect. It has an income tax, but it doesn't tax the money you're actually living on. If you're 55 or older, retirement income is completely exempt, pensions, 401ks, IRAs, all of it. Social Security is untouched, and Iowa's inheritance tax was fully repealed in 2025. So that's why all 3 of our families owe 0 state tax on their retirement income. Yes, Iowa has an income tax, but for retirees, it largely leaves the money you've spent decades building alone, which is exactly why the no income tax filter fails. The one trade-off? Property taxes run slightly above average, so door 4 is still open, but doors 1, 2, 3, all shut. That's income state number 1 on this list. The second one is next, and in my opinion, it might be the single best state in America to be retired in. Notice I didn't say the best state to retire in. There's a difference. I'm about to show you why. Up next, it's Pennsylvania. This is the twist I promised. A state that is almost unbeatable while you're alive, but changes when you look at what you leave behind. While you're alive, Pennsylvania is basically Florida. Social Security, pensions, 401ks, and IRA withdrawals are all exempt. All three families can pay essentially zero state income tax. But door 3 changes everything. Pennsylvania has an inheritance tax that starts at $1. No exemption, no threshold. Leave everything to your kids and the state takes 4.5%. Linda's $650,000 estate, about $29,000. The Millers, roughly $67,000. The Whitmans, around $130,000. That makes Pennsylvania the only state in the top 5 that reaches every family, including Linda. But she didn't skip the vacations and pack a lunch for 30 years so the state could take the first cut of what she leaves to her kids. When I sit down with families on this, that conversation is never really about the money. It's about what all the work was for. The verdict? Unbeatable while you're alive. But if leaving money behind matters, Pennsylvania requires planning. And the number 1 on this list, you guessed it, Florida. And on pure tax math, it earns the spot. No income tax, no estate tax, no inheritance tax. All three families, 0 every year, 0 at death. Florida closes 3 of the 4 doors. The catch is door 4. Homeowners insurance is where Florida fights back. Average premiums are roughly $7,000 to $8,000 a year, among the highest in America, with coastal areas often much higher before flood coverage, HOA fees, or condo assessments. That means a state that saves you money on taxes can quietly give some of it back through carrying costs. And that's what I meant at the very start. 9 states have 0 income tax, and this is how one can still drain your savings. Here's one more thing retirees miss. Florida's biggest property tax defenses, the homestead exemption and Save Our Homes cap, are not automatic. You have to file. Miss that deadline and you can pay thousands more than necessary. Florida is still number 1, but run the insurance quote before you list the house. So that's my top 5, but I do have a few honorable mentions that didn't make the list. Wyoming and South Dakota were close. They offer many of Florida's tax advantages, but with different trade-offs like climate and location. Texas also narrowly missed the list. It looks perfect on paper, no income tax, estate tax, or inheritance tax, but high property taxes keep door 4 open. Choosing the right state is only half the battle. The other half is making the move at the right time and in the right way. The timing of your move can matter just as much. First, move before your RMD years, 73 or 75 depending on your birth year. Every year you relocate before forced withdrawals begin is income your old state may never tax. Second, Roth conversions. They are taxed based on where you live and when you convert. A $100,000 conversion in Oregon could cost thousands. The same conversion in Florida or Nevada could cost 0. But there is one catch. The move has to be real. States don't just look at your new address. They look at where your life actually happens. Your license, voter registration, doctors, banking, and how many days you spend there. The reality is, there is no best state to retire in. There's only the best state for your life. I have clients who could save 5 figures a year by leaving and shouldn't because the grandkids are 20 miles away, and that's the entire point of retiring. A spreadsheet that ignores that isn't a plan, at least not for your life. But here's what I see stop people from ever getting there. Decisions like these feel permanent. That's exactly why people freeze for years, stuck in the dreaded 1 more year trap, grinding out an extra 12 months they might not even need, chasing a bigger number they're sure will change everything. If you want to know whether you're already there for your own numbers, that's exactly what we do at Allwealth Planning. The link to book a call is in the description, and I'll take a look at your situation. But before you trade another year for that bigger number, is it even worth it? Because we all assume twice the money means twice the retirement, and the numbers say otherwise. So I put 2 couples side by side, one with 1 million and one with 2 million, to show you exactly where that gap is real and where it disappears. Watch this one next, and I'll see you there.